Welcome to the deep dive. Today, we're going to tackle a corner of the energy sector that maybe doesn't always get the spotlight. We're comparing two giants, Kinder Morgan, that's KMI, and Enterprise Products Partners, EPD. They look pretty similar on the surface, right? Our mission here is to cut through that initial impression. We want to find the essential bits that really separate these two, especially if you're, interested in reliable income. It's about understanding why you might lean towards one instead of the other, going a bit deeper than just the headline numbers. So let's jump in. Okay, so the energy sector generally, it's known for being pretty wild, prices up, prices down. It can be a real roller coaster. That volatility usually sends ripples everywhere. But these companies, KMI and EPD, they kind of march to a slightly different beat, don't they? How do they handle all that market churn?
Yeah, that's a really good starting point. The key thing to grasp is that both Kinder Morgan and Enterprise Products Partners, they're what we call midstream companies. So think of them less like companies betting on oil or gas prices and more like toll takers. They run the energy superhighway, essentially. They sit between the upstream guys, the ones pulling energy out of the ground, or the downstream side, refining chemicals. Their job isn't really selling the oil itself. It's charging fees to move it, to store it, process it a bit through these huge networks they own.
Right.
They've got pipelines, massive storage tanks, all sorts of transport assets. The money they make, it mostly comes from fees, stable fees, often from long-term contracts. And those fees are usually based on how much stuff flows through the volume, not so much the actual dollar value of the oil or gas at that moment. So yeah, overall energy demand matters, of course, but the day-to-day price swings, less critical for them than just keeping those pipes full. It's a business model that's pretty attractive, pretty reliable, even inside a sector known for, chaos.
Okay, that makes sense. Toll takers. And yeah, from that angle, they do look like twins almost. I mean, these are two of the biggest players in North America, asset-wise. Market caps are neck and neck too, right? Kinder Morgan, around $64 billion? And EPD, about $67 billion.
Yeah, very close.
So, yeah, on paper, you might just think, okay, pick one. But this is where we really need to dig deeper because that similarity hides something really important, especially if income is your focus. All right, so we've got these two huge midstream toll takers. Their current dividend yields look pretty good. Kinder Morgan is around, 3.99%?
Mm-hmm.
And Enterprise Products Partners is higher, more like 6.83%. So that's interesting already. But just looking at today's yield, that doesn't tell the whole story, does it? There's this crucial history, this backstory, that really shapes how you might view their reliability for income. This is where it gets fascinating.
Absolutely. I mean, for income investing, looking back at how companies behave under pressure, that's incredibly revealing. Think back to 2016. That was a really tough time for energy.
Oh, yeah, I remember that downturn. Brutal.
Right. Well, during that period, Enterprise Products Partners actually raised its distribution. They gave investors a bit more income.
Okay.
Now, contrast that with Kinder Morgan. KMI, they cut their distribution, and not just a little trim. They cut it by 75%.
Wow, 75%. That's huge.
It was massive. Now, to be fair, the company said, look, this was strategic. We need the cash to strengthen the balance sheet, invest in growth. And, arguably, it did make the business stronger down the road. But for investors who were counting on that income, it was, a terrible outcome at the time. Especially because just a couple of months before the cut, management had actually been suggesting a dividend increase, maybe up to 10%.
Ouch. So they hinted at a raise, then delivered a massive cut. That's got to sting. That kind of thing really damages trust, doesn't it?
It absolutely can. It creates uncertainty.
That 75% cut must have felt like a real gut punch back then. A hard lesson. But playing devil's advocate for a second, maybe sometimes a really painful cut like that is actually the right strategic call for the long term, even if it hurts shareholders right away.
You could definitely make that argument. Sometimes tough medicine is needed. The problem often comes down to, communication, expectations, and the precedent it sets. Can investors trust what management says about the dividend going forward?
Right. It's about that track record.
Exactly. And 2016 wasn't the only test. Fast forward to 2020, another incredibly challenging time. The pandemic hit everything hard.
Yeah, global markets went haywire.
So what happened then? Well, Enterprise Products Partners, sticking to its pattern, delivered another modest distribution increase. Slow and steady.
Assistant.
Very. Kinder Morgan, meanwhile, again, didn't quite meet the, let's say, aggressive dividend growth path they had previously outlined. Now, the environment was incredibly uncertain, so maybe that miss was understandable. But when you put it all together, the pattern becomes pretty clear, doesn't it? Kinder Morgan, well, they've kind of let dividend investors down during both of the most recent major industry downturns. Enterprise Products Partners, on the other hand, has just reliably increased its distribution year after year for, what is it now, 26 years straight.
26 years, that's quite a streak, especially through all that volatility. Now, let's be fair to KMI. The company today, financially, business-wise, it's in much better shape than it was back in 2016.
True.
And you can make a case, like you said, that the 2020 dividend situation was maybe reasonable, given just how crazy and unpredictable everything was back then.
Agreed. The 2020 context was extraordinary, no doubt.
Yeah.
But look, if you're an investor and your absolute top priority is reliability, consistency.
Peace of mind, maybe?
Exactly. If you need to trust that management means what it says about your income stream,
Yeah.
especially when things get tough, well, then Enterprise Products Partners really does stand out. That history just speaks volumes about their commitment to that consistency. And let's not forget, you also get that higher starting yield right now, the 6.83%.
Okay, so boiling it all down, what's the main takeaway for someone listening? They look similar, same business model, huge scale.
Yeah.
But the real difference, the crucial one, it seems, is that history. Their track record on dividends, especially when the chips were down, that's what separates them.
That's the core of it. It really highlights how past actions, particularly through turbulence, can define which company might be a better fit for certain types of investors.
So this deep dive, it really shows you, doesn't it? Even when two investments seem almost identical on the surface, you scratch a bit deeper, look at the history, the management philosophy, and you can find some pretty profound differences.
Exactly. And maybe that leaves you with something to think about, right? When you evaluate companies, especially if you're in it for the long haul, how much weight should you actually give to management's track record? Not just the numbers on the balance sheet, but their history of promises made versus promises kept, particularly when times get tough. What does that pattern really tell you about who they are, what they prioritize, and ultimately what that might mean for you and your investment?